Okay, this is where it gets really exciting though, because when you use these life insurance accounts as an operating account, whether you're an investor or you're using this money to buy a home or a car and then repaying those loans as if you were your own bank, when you create your own finance mechanism and your own banking system, it gets really exciting. Okay, let's show you how that works. All right, right now the interest that's being credited on these life insurance accounts is 6%. That's the dividend rate that they're paying right now. Generally speaking, you'll earn 6 to 8% in these accounts tax-free. Okay, now think about this. As interest rates go up, so do rates of return. The insurance companies, what they do is they take your money, your premium dollars, the money that you're putting in the account, and they loan that money out to other productive assets or projects in the form of a bond. It's a very short-term bond though. It's 1 year, 3 year, 5 year, sometimes 7 year, never 10-year bonds. They don't buy U.S. Treasuries. They don't buy muni bonds, tax-free muni bonds, because those bonds are going to blow up in the near future. What they do is they loan the money against hard assets, real assets that are productive, that are generating income. And they keep those loans, those bonds, very short term, so that when inflation does spike and when the government loses control of inflation and interest rates go up to 15%, guess what your rate of return on your insurance account will look like? Your rate of return will go up with that, okay? But for right now, I'm just going to show you the actual dividend rate, which is 6% on these accounts. Now, let's say you have an opportunity, for example, like working with Jeff Ballard and the Hilton family in these VIP loans, all right? The VIP loan opportunity is earning anywhere from 16 to 18%. Cash on cash return. That's checks in the mail, money in the door. All right. Well, what do when you have an opportunity like that? All you do is you go to your account, your insurance account, your reserve capital account is what we're calling it. You take out a loan at preferred interest rates. Now, right now, these loan rates are extremely low. So are rates of return. As interest rates spike, if interest rates go up to 15%, so will your rates of return on the account, okay? So you'll always be able to earn a spread between what you're getting and what you're paying on these loans, all right? So let's say you borrow $50,000 out and you put it into an opportunity with Jeff and you're just earning 15%, all right? Well, the difference between what you're borrowing and what you're earning on that deal, the difference between those two numbers is what we call arbitrage. This is the concept of arbitrage. This is what banks and credit unions have been doing to us forever. All right, you have a savings account at a bank. What do they pay you on the savings account? 1% maybe? And then they take your money and they loan it out to you for a car loan at 6%. So they're paying you 1%. You're earning 1% on your money, and then you're paying them 6% on your car loan. That's arbitrage. It's actually reverse arbitrage. So by creating this mechanism, you're able to earn arbitrage, which is just the difference between what you're paying and what you're earning on that deal. All right? Now, in this instance, the difference between 4.5% and 15% is 10.5%, or $52.50 a year based on this $50,000 investment. You follow me? So the arbitrage factor in this case is 10.5% on that deal. But wait a second. What about the money? What about the 6% interest that you're earning on that original $50,000 in your life insurance account? Because all you've done is collateralize the account, taken out the money, taken out a loan against the account. Your $50,000 is still growing at 6%. So the true rate of return, the actual effective rate of return on this scenario is 16.5%. Does that make sense? 16.5%, not the 15%. As if you just wrote a check to Jeff and invested in that loan deal with the Hilton family, you would earn 15 or 16%, whatever the number is. But by using this system, you're able to increase or stack those rates of return on top of themselves. All right? Does that make sense? Okay, now there's 3 things that you can do with the money, with this $52.50 a year that you're earning, the dividends that you're earning from this financial opportunity. All right? You have 3 options. The first option is to repay the loan. When you repay this loan and you eliminate the lien, that $50,000 loan that's accruing interest at 4.5%, all of the interest that is accrued on that loan is credited back to your life insurance account. Let me say that again. When you repay the loan, they simply remove the lien from your account, and any interest that's accrued on your account is credited back to your life insurance account in the form of cash dividends. All right? So we always recommend that you repay the loan first, because you're also recapitalizing your banking system and you can do it all over again. But you can choose to do whatever you want. You can take that $52.50 a year and add it back into the deal and just reinvest those dividends. All right? The third option that you have is you can buy more life insurance. Maybe use that $52.50 a year and open up a policy on your kiddos and use that money as a college fund, for example, for the next 15 years or however long you have until they go to college. All right? So there are lots of options within the system on how you want to repay the loan or use the money that you're earning in this arbitrage scenario. Okay? Now, when you repay the loans, there's benefits to that because you get tax-deferred growth on all of the money. When you borrow against your account and use it as income, it's tax-free income to you because it's a loan, not income. You get good competitive rates of return or dividend crediting. You can put as much money into these accounts as you want, or another way of saying that is you can open up as many policies as you want on other people. I mean, obviously, you can't buy a $100 million life insurance policy on yourself without justifying that you're worth $100 million, okay? So the alternative is maybe you open it up with a business partner and you have a policy on your business partner and you stuff cash into that policy. You have additional benefits that are living benefits, like an accelerated benefit rider that comes free with every policy, and that's in case you get cancer or some kind of life-threatening illness. What they do is they pay the death benefit to you up front, tax-free, to help cover the expenses of that medical condition. Or if you have a life-threatening illness that requires long-term care, or you have to go into a nursing home, for example, when you get older, you can get the death benefit paid to your family or to you tax-free to help cover the costs of long-term care. All right? You get guaranteed loans with these accounts. They are considered a safe harbor, meaning they're lawsuit-proof, judgment-proof, and creditor-proof. Nobody can touch the money inside your life insurance policy, which is another reason why we always recommend that you repay these loans first and cycle the money through these accounts. If you're ever sued at all, nobody can touch the money in these policies. All right? You have guaranteed no loss provisions. You guaranteed not to lose the money on this account, any cash that's in the account. Guaranteed loan option, like we talked about before. You don't have to pay the loans back on any type of schedule. You determine the loan repayment because you're the boss. You're the manager of the account. You have full liquid use and control of your funds. And if you set it up correctly, the contributions or the money that you put into the account and the loan repayment can be a tax deduction to you. All right? We can go into that in the tax strategies video or in the safety and security section of the website. Okay? Huge concepts here.